Welcome everyone to today's webinar. I'm Nina, CIO at AQVC Venture Capital, and today Amir and I will give an overview about common VC fund matrices, as well as introduce the private market equivalent to you, which is a basic concept for performance benchmarking. So over to you, Amir.
Thank you, Nina. Hello, everybody. My name is Amir Awadi, and I'm VP of Investments at AQVC Venture Capital. And I'm going to walk you through the fundamentals of VC fund metrics and benchmarking, because we think that it's equally important for both GPs and LPs to understand these fundamentals. I think that on the GP side, it's important because one of the first checks that an LP does when evaluating your fund is basically to look at your past performance and then benchmark it and compare it to other funds, to other VC funds that share the same vintage year. And from an LP's perspective, what is important to know that there are very clear definitions and formulas on how to calculate these metrics. So it's super important to make sure that you are using the correct formulas and ways of these metrics. Taking a step back, before diving deep into the VC fund metrics, I think it's important to understand what is a VC fund's vintage year, how is it set, and who actually defines it. So if you take a quick look at the upper side of the slide, you can see that a typical VC fund's life cycle ranges from 6 months to 24 months. It usually starts with the legal formation or the inception date, and then on to the first closing once you have the first few LPs and then the first capital call. So you can start making the first investments, and then to the final closing, and then also sometimes there are even more than 2 or 3 closings before that. So if you ask us, we personally think that a vintage year should be defined on the same year that the first capital call was made, because this is when the IRR clock starts ticking, basically. However, Cambridge Associates, the most widely used VC benchmarking report, defines the vintage year by the legal inception date of a venture fund, which can usually be found in the financial statements on the notes section. So when benchmarking a VC fund, it's very important to understand the benchmark report that you are using and how do they define vintage year, so that you can evaluate the fund that you're looking at in the correct way, and then compare apples to apples. Sorry. Yes, so diving a little bit deeper on VC fund metrics, there are basically 2 groups. There are the money multiples, TVPI, RVPI, DPI, and MOIC. This is a relatively easy to understand, easy to calculate set of metrics. However, one main limitation here is that these metrics do not take into account the time value of money. And this is where the internal rate of return, IRR, comes into play, where in contrast to the money multiples, the IRR does take into account the time value of money in its calculation formula. However, a main limitation of the IRR is that it is less relevant during the first few years of a fund's life cycle, because it's mostly based on unrealized gains that are based on the net asset value, which is set by the GPs. So you need to take that into account. So I think separately, each of these groups provides a limited overview of the fund performance, but by combining them and looking at them together, they give a very insightful and good overview of a fund performance. Okay, so diving a little bit deeper into the VC fund metrics and how are they calculated, we need to understand 6 very important metrics first. The first metric is the paid-in capital, which is what we call the capital call. It's the money being transferred from the LP's bank account into the VC fund's bank account. The second metric is the distributed capital, which is the money flowing the opposite way. So basically the distributions flowing from the VC fund's bank account into the LP's or the investor's bank accounts. The third metric is the net asset value, which is the unrealized gains that we also call the capital call. So the collective capital calls of capital accounts, the collective capital accounts of all the LPs basically constitute the net asset value of a venture fund. You need to make an important note here that all these three metrics are net of fees, carried interest, and expenses. This is very important when calculating these metrics. The fourth metric is the investment cost, which is basically the money flowing from the VC fund into the portfolio companies, so the cost basis of these companies. The fifth metric is the investment proceeds or returns once there is an exit event. So it's the cash flowing from the portfolio companies back into the VC fund. And then the sixth and final metric is the investment book value or the fair value of these portfolio companies, basically shown on a fund's financial statements as unrealized fair value. So if you take a look at the table in the middle of the slide, you can see the money multiples and how they are calculated. We start with the MOIC, or multiple on invested capital, which is a gross multiple. So this is less relevant for LPs. However, we still see it in many of the decks that we review. So it's still very widely used by managers. And it's basically just taking the investment proceeds plus the fair value of these portfolio companies divided by the cost basis of portfolio companies. The next set of metrics, the net metrics, are the most relevant metrics. The benchmarkable metrics and the metrics that most LPs look at are the RVPI, DPI, and TVPI. So we start with the RVPI, which is the residual value to paid-in capital. So it's basically calculated by looking at the NAV, the net asset value. Again, net of fees, expenses, and provisional carry. This is super important. Divided by the paid-in capital, the capital that the LPs have wired to the VC fund. Next is the DPI, the distributions to paid-in capital, which is basically calculated by the distributions, net of fees, carry, and expenses. Basically going from the VC fund into the LP's accounts divided by the paid-in capital, which is the capital calls. And then finally, ultimately, you have the TVPI, the most widely used and known metric in evaluating venture funds, which is basically just the combination or the sum of these two metrics, RVPI and DPI. Moving to the right-hand side of the slide, you can see the table showing the calculations of the IRR. Again, here we also show the gross IRR and the gross realized IRR because it is widely used by fund manager. However, this is less relevant for LPs, and this is not benchmarkable. Many of the benchmarks do not actually use this metric. So we go into the next two metrics, which are the net IRR and net realized IRR. The most used metric is the net IRR. And in calculating the net IRR, you basically take the cash flowing out and cash flowing in plus the net asset value of the fund. So basically, the cash flowing out are the capital calls, the paid-in capital, and then the cash inflows are split into two groups. One is the realized aspect, which is the distributed capital, the second metric we discussed. And then the second is basically the net asset value, which is the fair value net of fees, carried, and expenses as of the date that you're calculating the IRR at. So if we take a quick look at simulation of the evolution of these metrics across a fund's life cycle, you can see that in the first few years, the TVPI is basically equal to the RVPI. Okay, this is unrealized value. This is residual value. The fund hasn't started distributing capital yet. And then as the fund evolves and start distributing cash back to its LPs, the TVPI is a combination of the RVPI and the DPI. And then eventually, by the end of the fund's life cycle, once the capital is liquidated and all of the cash is transferred back to the LPs, the TVPI is actually equal to the DPI, and this is basically the final multiple or the final performance metric of a venture fund. So just to summarize and to add a few closing remarks, I think that when evaluating a VC fund, it's super important to take into account first the benchmarking report that you're using. How do they define vintage year? Because it's super important to make sure that this vintage year is the same definition that you're using for the venture fund that you're evaluating. Third, I will add that you need to make sure that these performance metrics are being calculated in the right way and that they are not taking into account fees, expenses, and provisional carry. So make these calculations on your own using the fund's financial statements. Don't take them as a given. I would also add that looking at IRR and money multiples collectively together and not separately gives you much more insight and overview of the fund's performance. I will also add that a true fund's IRR is ultimately based on the flow of capital or a flow of cash in and out of an LP's account. This is why, as I mentioned, in the first few years of a fund's life cycle, this is less relevant. This is mostly based on unrealized gains, based on NAV. And the one setting the NAV is the GP. So you need to look at the valuation policy and how what does he use as a policy to evaluate these unrealized holdings. And then lastly, I would say that money multiples and IRR are important, but only one factor of evaluating a venture fund. It's a whole process which includes many other both quantitative and qualitative aspects. On the quantitative side, you also need to look at loss ratios, fund model, portfolio construction, holding percentages, and so on. And on the qualitative side, you need to do a lot of reference calls with CEOs, LPs, co-investors. You need to evaluate the team dynamics, the investment decision process, and so on. So this is also very dynamic because when you are looking more at the emerging side of the venture funds, then the qualitative measures are more important, more relevant. But once the fund is more established, you have more numbers and more quantitative analysis to do. So handing it over to you, Nina.
Thank you, Mia. And yes, as said, let's now look at the public market equivalent, which is actually a methodology to do performance benchmarking next to the performance measures that Amir just outlined on the VC side. Because what the PME actually does, it's important. What the PME actually does, and this is also why it's an interesting metrics for both asset allocators and GPs, it not only allows to compare public markets and private markets. So instead of like allocating capital into private markets, what had happened if you would have just bought a stock on the public market, which is actually also commonly known as the illiquidity premium. So how much extra return do I get by investing in the rather illiquid asset class rather than a public asset class? But what it also allows, and this is also displayed on the left side here, is it also allows to compare between private market asset classes, but also within venture capital. You could think, for instance, to compare US venture capital and European venture capital, and also allows for that. So theoretically, sounds like a pretty convenient method to have. And we also, as you've seen on the last slide, looks like venture capital outperformed all other asset classes in the past. And normally, when you look at the data requirements, it actually builds on realized cash flows, net of fee values. But there is an issue because not always, and actually most of the time, realized cash flows between venture capital and let's take a public market index don't match, which is also commonly known as the negative NAV or shortness issue. And as Amir already outlined, Cambridge Associates is one of the primary data providers when it comes to benchmarks. And they also modified this method, which is called the modified PME, and actually use the net asset value as a concept to overcome this gap. So actually how it works, and I will show it in a brief example in a second, is that actually they are transferring the methodology used for private market KPI measurement to public markets. But as you also will see, it's still an issue because when you look at public markets, it's rather a time-weighted return logic, whereas private markets is a money-weighted return logic. And also, contributions are made over a longer period of time, and distributions rather, as Amir also explained, coming in later. So also there are some caveats, but nevertheless, it's a useful measure to have. So how it technically works, and we would really also like to encourage you, in case you are interested to understand the MPME method a bit more, to really go on the website of Cambridge Associates, because this is also where you will find an in-depth explanation how the method works. So in principle, whenever there is a contribution to a VC fund, which you could think about like a paid-in capital, you assume you buy a stock, and whenever there is a distribution, you sell the same proportion of the stock, and that also gives you your net cash flow and a net asset value. And what it does in the end, and this is also what is a convenient thing to do here, is when you look at contributions and distributions, you're able to come up with a comparable MOIC. And when you look at the net cash flow you're ending up with, you can also calculate an IRR. When you only look at the distributions, this is your equivalent to a DPI, and goes on and on. What is also important here is that you always compare apples with apples. So if you look at US venture capital, the NASDAQ is your index of choice. If you want to look at venture capital globally, you would probably seek to compare this with the MSCI. And I think, yeah, for GPs, it's also a good thing to have, to actually also show why it's worth to invest in private markets. Another study that we find very interesting was done by Hatcham. So they compared VC returns using the public market equivalents, but they also looked at the underlying values and put those into buckets in line with their timing. And they've done the same on the public market side, primarily using the S&P 500 and the NASDAQ. And when they compared those data points for public markets, they found that those are more or less, not perfectly, but more or less normally distributed. On the venture capital side, on the venture capital side, and that's actually a very interesting analysis to look into, you find that this is following a power law. So you will see a very, very few funds really showing out performance, and a lot of other funds showing like very, very low performance. This is also why when we look at funds, we like to put them into buckets, like both which in line with quartiles. So the best ones would be in the 5% quartile, and that's like really strong outperformance. But we're also frequently speaking about top quartile performance, so like the top 25%. And when you look at the distribution, you see that this really makes a difference when it comes to performance. But it also means that the public market equivalent to venture capital is only like a very generalist approach on performance benchmarking. And it also shows how important it is to pick the right managers in venture if you really want to achieve significant outperformance. So taking together, the PME allows for relative comparison of performance between private and public markets. It's always important that you compare similar bases, like apples with apples, and that there are methodological caveats. So it's like really a very, very tricky methodology if you want to do it right. And you need to have a lot of data points and good data quality as well. One of the leading providers here is Cambridge Associates. So really encourage you to have a look at their website to understand this metric better, which basically assumes that when there is a commitment, it reflects a stock purchase. And if there's distribution, it's the same. But also please be always also in mind that distributions are different between public and private markets, which is also hindering comparison if you want to do it statistically correctly, because venture follows a power law, which again puts emphasis on picking the right manager. And this is what we're here for, and very happy to take your questions.
Yeah, I think one thing I'll add on benchmarking, Nina, is that it's important to understand that there are a lot of caveats, right? As you mentioned before, Cambridge Associates is one of the most widely or commonly used benchmarking, but need to also keep in mind that even though they are very aligned on the vintage year selection, they basically put all funds in the same bucket. So you have in the same benchmark, you have smaller funds, you have larger funds, you have emerging managers, you have established managers, you have early stage, you have growth stage managers. So even when you're benchmarking fund performance, need to take into account that this is being compared to a large, very wide group set of VC funds. So also important to take that into account. It also includes both specialized and generalist fund managers. Unfortunately, they do show some breakdowns of some of these aspects, but not on a fully comparable or benchmarkable basis. So need to always take that into account as well. Yeah, I mean, there are other benchmarking reports out there as well. PitchBook, for example, offers their own benchmarking tool as well. But again, this is a relatively new asset class, very few data points, and the numbers are still relatively small. So this will evolve with time as well. So just need to take that into account as well.
Yeah, no, and I think also the distribution aspect is an important one, which is also a clear difference to private equity, which is where the methodology originally came from. Which is, I think, also shown in what you explained earlier.
Yeah, exactly. Yeah. So
do we have any more questions?
Let's see if we have any questions here. So we have one question, Nina, if you want to take it. Somebody is asking if is it common to sign term sheets with LPs? I'm assuming in terms of like LOIs.
Yeah, I mean, if you go out fundraising as an emerging manager and you're getting a term sheet signed, I think, please take it. It's also signaling for other LPs who might want to join you as well. Commitments might take time and people take time to due diligence, but of course, if there is an LP offers a term sheet, please do. Or maybe also, if you're an emerging manager, also really look to sign term sheets with LPs early on.
Yeah,
absolutely.
I agree with that as well.
Anything else?
Let's see if we have any more questions. So another question that came in, are there any special considerations for emerging managers when benchmarking? So as I had already mentioned before, emerging managers are usually managers in their first, second, or even third fund generation. Data is very limited, performance data is very, very limited. So benchmarking is maybe less relevant when evaluating these managers. So you try to look at different aspects. You do benchmark the numbers, but you all look for other quantitative aspects as well. For example, emerging managers are usually early stage managers, seed stage investors, right? So you want to maybe try to look at, who are the funds that are investing after these managers? Who are the follow-on investors for these seed stage investors and emerging managers? Are they attracting the top tier managers? This is, for example, one metric that you should be looking at.
And actually also the analysis that shows that emerging managers in a lot of cases outperform established ones. I mean, there are also some analysis out there.
Yes, exactly. And naturally it takes a lot of time to see that, but there are different aspects that we should be looking at when considering emerging managers other than benchmarking.
True.
Another question that came in says, when calculating IRR, when is the first year to take into account? Is it the first capital call? Yes, so naturally, an IRR, as I mentioned, is based on the cash flowing out and in of an LP's bank account. So naturally, when you're calculating the IRR, as I said, the clock starts ticking the minute you basically transfer your first capital call. We have another question here.
And I think it's the final one, looking at the time.
Yes, we're out of time. What value do you attach to being on the LPAC of a fund? At what size of investment it would make sense to push for the seat?
Well, I mean, on the LPAC, I mean, it's good that are reserved matters that are getting discussed, like conflicts of interest at the LPAC. Nevertheless, it doesn't give you operational power over the fund per se, but it also helps you to be close to the fund managers, which is something whenever you do a commitment, you should look for anyways, that you build this relationship. So I think, yeah, it's a good thing to have, and it has to be established. I mean, usually it's like the largest investors that join the LPAC, but it also depends a little bit on the VCs and how they manage. But that's like the common thing that we see. But yeah, I think being close is always a good thing, and
Yeah, I think that the most common thing we see is that it's usually comprised of the 4 or 5 largest investors, usually over 10% of the fund. Not always, again, depending on the profile of these LPs. And sometimes it's constituted in the LPA who can be part of the LPAC.
Exactly, and sometimes
yes, exactly. It's we see different types of LPAC compositions.
Yeah,
perfect.
Okay, so thank you very much for joining. If there are any unanswered questions, please feel free to reach out to us. And yeah,
thank you.
That was useful. Thank you.